All right, we are live. Hello, everyone. Welcome back to another live stream on the channel pre-market. Again, if you would like to see aftermarket live streams, let me know in the comments. Maybe I'll create a community post so it's a bit easier to see where everyone's at with those live streams. Hi, Lance. How are you doing? So today we have a couple of things to discuss: oil, Boeing, Palantir, and then Morgan Stanley a cut with regards to the China's auto sector. So quite a lot of things to go through. I'll just double check if everything is working correctly. Join in. Okay, sound is working. That's great. Okay. Join in, make yourself comfortable. Good morning, good afternoon, wherever you're watching from. So, a couple of things today. First up, we've got oil prices coming down, which, to be honest, should be viewed as something positive. Because with everything that's happening in the Red Sea, people are saying, oh, oil prices will go up, inflation will increase, and so the market will react negatively. Currently, we're seeing this.
For the first time, American energy, domestic oil production at a record high, and the U.S. is now the world's largest natural gas exporter for the first time ever. Who surfaced those fun facts for us? Yahoo Finance's Rick Newman is here with a look at this, and you have been watching the sort of interplay of the U.S. energy industry with the administration, but also the energy industry on its own, which has been growing.
I mean, let's just look at the basics here. So Joe Biden is the most vocal green energy president we've ever had. He made a campaign promise to end fossil fuel. So who would have thought that 3 years into Biden's presidency, we would be at record production of crude oil, record exports of crude oil, and the same for natural gas, record production and record exports. I don't think anybody, and that is not Biden's doing, that is the market doing what it does. We know fracking in the United States has unleashed all these extra reserves that were unreachable before. Energy drillers got completely burned in 2020. Some of them went out of business. A lot of them lost a ton of money because oil prices basically went down to zero. And so they pulled in. They said, we're not just going to flood the market with supply anymore. They were pretty disciplined for a while. But we've had prices, between 70 and 100 for 2 years. And before that, they were over 100. So that has slowly just coaxed more energy onto the market here in the United States. And honestly, thank goodness, because look what's going on around the world. Vladimir Putin in Russia clearly has tried to weaponize energy and hold the West hostage to Russia's oil and gas supplies, right? You've got OPEC Plus cartel is cutting supplies. They want to keep the price up. And here comes all this American energy that, it's a miracle in a way that energy prices, that we've got oil around 72, given what's happening with Russia, given that we have a war in the Middle East, we've got a tax on ships in the Red Sea, and yet oil is around 72. It's a normal price, and gas prices are around $3, $3.10 a gallon. That's a lot of that has to do with all this U.S. energy that's coming onto the market.
Are you surprised at all, Rick, that the oil market hasn't reacted more dramatically to that conflict in the Middle East? Because the fear was Iran-Hamas would spread, but it has spread. It's in Lebanon. It's in the Red Sea. You have Iran-backed militia groups. They're attacking U.S. Navy assets. They're attacking commercial shippers. Are you surprised there's not more response?
I am not surprised, because anybody who follows the oil markets is intimately familiar with turmoil in the Middle East. You can't get away from it. It's been worse in the past. I mean, when we were more dependent on Middle East oil from Saudi Arabia and Iran and Iraq and Kuwait and so on. I mean, Gulf War 1990, So I think people who follow the oil market know that it's in every oil producer in the Middle East. It is in their interest, for the most part, to keep the market stable. Now, yes, some of them would benefit if prices went through the roof, but some of them would also get hurt because it would be their supplies that are not getting onto the market. Would that be Iran, because it does something provocative that brings a tax on Iranian oil infrastructure? Would it be other Gulf states that can't get their oil out through the Strait of Hormuz? Nobody's willing to take the step over there. I mean, yes, we have seen escalation, but we have not seen that kind of escalation. And there's probably some, deliberate self-interest at work there. So look, this could light off in an instant. If we had one bomb in the wrong place, if something happens that looks like it's going to presage a U.S.-Iranian shooting war, all bets are off. I mean, we could have oil at 150 tomorrow easily, but nobody really wants that to happen. So far it hasn't happened.
And just quickly, if we did not see a crimping of the U.S. energy industry over the past few years and under Biden, does that mean that's it? It's, in other words, are we going to continue to see the kind of growth that we have been seeing?
I don't think so. And the other part of the story is that even though we are having record fossil fuel production here in the United States, we are also emitting less carbon. I mean, this trend of reduced carbon emissions in the United States is still on track. We are replacing coal-fired plants with natural gas plants, and in some cases with wind and solar plants. That's good. So we are moving down the path toward decarbonization. We're getting more electric vehicle adoption, and we're only seeing the beginning of all those green energy incentives that were in the 2022 Inflation Reduction Act. Those are only just starting to come in, and that's going to incentivize tons of new green energy investments. So right now, it's kind of a Goldilocks market in the United States, in the energy market. It could change, but something's going right.
All right,
Not
enjoy
bad.
it.
Well, he's not wrong at all, right? The fact that oil prices, which right now you can see crude oil sits at $71, right? We were a year ago, in September, it was $90. September was $90. If you look at the past 5 years, we're basically not that far away from 2019. Even with everything that's going on right now, that's a pretty good place to be. With Saudi Arabia now cutting their prices a little bit here, oil sinks. We see Saudi price cuts counter Middle East worries. Again, it's all about supply demand. When a country like that has too much supply, of course, if there is a lot of demand, if there is turmoil, they can maybe increase prices. But right now, maybe they're feeling like, maybe in this market would be better for us if we reduce prices. And so this is what happens. And with regards to the green movement, look, I see a strategic point into moving into renewables, right? Renewable energy, all of that, it's a strategic movement. Now, the way it has been portrayed or done previously, or in the last couple of years, was probably not the smartest thing, right? Oh, abolish everything. Oil, not good. Let's shut everything down. Let's shut every driller down. That's not the way to go. I mean, we've seen what happens, right? We still need all of those resources right now, even if we want to go into a greener future. I mean, there are ways to drill more efficiently. Green energy. I mean, there are plenty of ways to do that. Why not immediately destroying that industry? And again, the US is producing quite a lot right now, and still, as he said, the carbon output comes down, which is exactly what you want to see. But of course, there is always radical movements on both sides. One side really pushing towards only green, even though they know, or maybe they don't know that everything in their lives right now would disappear if there would be zero oil production, if there would be zero factories that, yes, pollute the air a little bit. But right now, that's just what we have to deal with, unfortunately, or fortunately. TB asks here, very insightful content. Do you have any new thoughts on hims and hers? No, zero new thoughts. Waiting for the next earnings report and earnings call to see the progress, especially the profitability side. With looking at the future of energy, what are we thinking for energy stocks? NEAN is the Nextera, comes to mind, as the solar stocks, as solar is very, very cheap. Yeah, I mean, companies were, let's have a look maybe right now already with Nextera. So of course, last year, right towards the end of last year, there was that big drop here. But since then, it has recovered quite well. So currently, can you see it correctly? Maybe I'll remove this and do this. So currently, for fiscal year 2023, EPS is not growing as fast as previously, only 7.8% increase year over year. Sales growth quite a lot, 25.49%. But then deceleration in 2024, EPS growing faster, and then back to, let's say, normal in 2025 with now a forward PE of 18.7 times. Yes, energy stocks, I mean, we've talked a bit about the other ones in the previous live streams, First Solar, Enphase, different energy stocks out there. Yes, they look cheap, but there is a reason. The reason is uncertainty. We don't know when demand will reaccelerate, especially not with the likes of Solar Edge and Enphase. Stock has been hit, stock has been lower as well, has rallied a lot. But just because we know that, or we assume that interest rates will come down in 2024, does not mean that demand has already accelerated. Not at all. So it remains to be seen. It remains to be seen what happens with that. Energy, there are probably some good companies to look at. Maybe I'll do a video on that later this week or maybe in the coming weeks. What is your opinion, thoughts on hydrogen? I mean, I talked about Plug last week, one stock to sell. I think it's there are probably some use cases for it, but to be honest, when you can go with solar, wind, why do you need hydrogen? Highly inflammable. So yeah, no for me. Moving on to the planes, which is Boeing, which I feel they really can't catch a break, and maybe that's their fault. So let's have a listen.
We've got 80% of analysts having a buy rating here and 18% having a hold on Boeing. So what is the biggest silver lining for this name that analysts are really pointing to here?
Well, I'll speak for myself. My position on the stock in the last 2 to 3 years has been, and COVID's in the past, okay, but sales had bottomed for commercial aircraft to like 20 billion, and over time you knew that was going to come back to 60 billion. That can't not work. They're making, the revenue progress is coming back. So the problem is making money. And they have really struggled the last couple of years. I mean, when I compare, no two things are exactly the same, but when I compare, say, a 2-year period, like around 2009, 2010, they had to combine those 2 years, maybe about 130 billion of revenue, and they made like, $6, $7, $8 cumulatively. Last 2 years, the same revenue base, they've reported $17 billion of losses. So there's still work to do execution-wise. The silver lining is that expectations of the company are very low.
Right. When it comes to some of the supply chain, the fact that we have seen a bit of a change in their supply chain, in terms of the risk that could pose or how that positions Boeing against some of the rivals, how does Boeing stack up?
So a couple of things on the supply chain side. There were a couple specific things, both relating to the fuselage, which they purchased their fuselages from Sprint, which had been their own operations till about 20 some years ago. Okay, I'm sorry, I said Sprint. I meant Spirit Air. My apologies on that. And the industry had been complaining about labor shortages, but I would submit that labor can be found if you treat it right. In terms of how they're positioned versus competitors, they only have one. It's Airbus. Okay, so the world wants 2 large commercial aircraft manufacturers, and besides China, of course, and the other one's Airbus. So no matter what, they're going to have their 40% market share on the downside. Airbus, of course, is doing much better than they are. They're coming in with higher deliveries, higher profitability, and I don't think anything changes that for the foreseeable future between the two. Boeing will get its share, but their focus is and needs to be to actually drive profitability, and that's where they are.
So Boeing If we look at the stock right now, the stock is down. The stock is down 7.37% after what happened during the weekend. Basically, it's not really funny, but a window just got destroyed from the plane. Thank God nobody was sitting at the window, which means this might be now the biggest transfer of window people to aisle seats. I already switched a couple of years ago, so I'm not that angry. But anyways, Boeing. If we look at the company right now, market cap $150 billion, has a forward PE of 178.9 times. Why is that? Well, right now, like the guy said, they took a hit, right? They took a hit. So fiscal year 2023, it's here at the bottom. Sales of just $76.63 billion. I say only because if you look at the previous number, it was much higher. So only a growth of 15% year over year, with an EPS loss of $6.32. But in fiscal year 2024, we're at EPS of $4.18, and we're now back, let's say, on track. Revenue $91 billion, that increased 18% year over year. Fiscal year 2025, another 11%, and we're now at $101 billion in sales and EPS of $8.10, 93%, close to 94% year over year increase at the bottom line. With regards to analyst price target, sits at 8% higher than the price we're at today, probably a bit lower right now with the pre-market action. If we look at the shares outstanding, well, since 2019, shares outstanding have increased. Free cash flow per share has decreased, of course. Pandemic era, huge hit on the company. Lots of issues with the 737 MAX. So that was expected. Then if we look at the valuation, all over the place, PE, V to EBITDA, price to sales, price to free cash flow is the only one that actually stayed a bit stable in the last years or so. But all the rest, yeah, looks a bit ridiculous right now. If we look out 20 years out, you can see that from 2019, the company has been taking hits, each and every quarter. And then, of course, with the pandemic, a major blow, but has seen some reacceleration recently. We can see that, of course, with free cash flow in this fiscal year has become a bit better. Gross profit margin has increased as well, and so has return on capital. So, maybe there might be something interesting here, but yeah. Have a good one. Have a great week, Mr. Tesla. But yeah, I don't know. They still have to figure out a lot of stuff with regards to their plane reliability, because these things can't keep happening each and every time. It's Boeing. These things can't keep happening. But yeah, remains to be seen. Remains to be seen. Not sure if you can touch on Joby or Archer. It's the flying car taxis thing, right? I think it's that. Yeah, people can't really drive on the road, so why should we give people flying cars? But yeah, in the name of innovation, I guess. So this is Joby Aviation, $4.24 billion in market cap. Sales of just 1.12 million in fiscal year 2023, but a huge increase in 2024 and 2025. These are the estimates, right? In 2025 fiscal year, they should be generating $84.5 million in revenue. Obviously, still losing money. But yeah, it's a gamble. It's a gamble. It's early days, so we'll see. I think Jason from the All In podcast is also invested or something like that, which might be a red flag. So yeah, I don't know. It's definitely not cheap. It's a gamble. If you want to gamble in the aviation space and space in general, maybe Rocket Lab could be a better pick. Archer Aviation. Archer a bit smaller, but might be a better bet here. So market cap 1.66 billion. And here in fiscal year 2025, they will generate approximately the same thing as Joby, right? $83.5 million, also still unprofitable. But yeah, maybe you're getting here something cheaper. Of course, I haven't looked at those companies deeper, so I don't know if both of them are on the same road. So we'll see. Some has already some permissions, some testing, flights, FAA, stuff like that. That's very, very important when looking at these types of companies. If one is one step ahead or two steps ahead, then yes, it deserves probably a higher multiple. But yeah, it's a bet. It's a bet. You're welcome, Lance. You're welcome. What do you think are the best risk-reward growth stocks at the moment? I still have to put PayPal in that category. Even though people don't think it's a growth stock, I still think there is a very, very good risk-reward here with PayPal. Robinhood as well, even though the stock has gone up more than PayPal, but still undervalued. And then there are plenty of others. Plenty of other companies in the healthcare industry. I wrote down, we talked about last week, Cooper Standard looks very, very attractive. The video that went live 7 minutes ago, Paycom, looks very interesting. And then, yeah, plenty of companies in the healthcare sector that look attractive right now, with a good risk reward, good balance sheet, cash generating. Some of them even pay you a dividend. I am working on I'm still researching on a couple of companies with regards to the healthcare sector. I think that could be a good play in 2024. So yeah, there is that. What did I want to touch on? Oh yes, this Palantir. Poof. We've got some news here with regards to Palantir. So apparently, OptionCare Health selects Palantir AIP platform for enterprise AI platform for enterprise-wide digital transformation. So, blah 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 blah. So OptionCare Health is the nation's largest independent national provider of home and alternate site infusion services. Today announced a multi-year commercial partnership for Palantir software to be leveraged across the company to help improve patient outcomes and increase efficiency. OptionCare Health expects to use Palantir, so the AIP platform, across nurse scheduling, patient onboarding, purchasing optimization, and supply chain execution, among other potential use cases. So here they explain a bit what is AIP. I'll read it, even though most of you already know what it is. So AIP enables organizations to bring the power of LLMs, large language models, and other cutting-edge AI to their enterprise networks. Private data, very important for all those that still think that Palantir is somehow stealing people's data and making it public or whatever. And core operations with maximum security and trust. The platform is designed to bring in siloed and disconnected data sources, logic assets, and systems of action into a single common operating picture, enabling users to optimize their decision making. Again, it's very important here. This is not replacing humans. This is making the decision for humans much easier, much clearer. The company's use of Palantir software is designed to help optimize visits per day and increase patient face time with clinicians, reduce administrative burden, and help ensure stockage of drugs and medical supplies while helping prevent overstocking. I think Palantir will have such a huge huge positive effect on the healthcare sector, and it would be a shame for a company or an organization not to partner up with the likes of Palantir. Again, some people still think this is an evil spy, American CIA type of company. Okay, they will miss out and they probably don't really care about patient satisfaction or the health of the healthcare industry. But I don't make the rules. We are excited to partner with one of the innovative leaders in AI-powered software and leverage their platform and expertise to enhance our intelligent technology ecosystem focused on streamlining processes, enhancing our expertise, improving the patient experience, and optimizing clinical outcomes, the words of the CEO and president. I believe that utilizing Palantir's Foundry and AIP will allow us to innovate rapidly, build on best practices, and help ensure our approach to AI and machine learning incorporates the strongest foundations and provides strong protection and integrity for our stakeholders. Palantir has long worked with some of the world's most important organizations. So Option Care Health is at the leading edge of deploying artificial intelligence across the healthcare sector. Words of Alex Karp. We are proud to support this effort, which builds on our expanding presence in and commitment to medical sector and will expedite and improve services to patients across the country. Now, this is great news. I don't know how much this contract will be. Maybe it's written somewhere. Maybe some of you can tell me in the comment section, but good news. Good news for Palantir. Something has been going on with my Wi-Fi connection today. It's a bit strange. I know they're working somewhere in the street, but still shouldn't affect my connection that much. Let's have a look. Palantir right now. Palantir right now looks like this. So market cap $34.7 billion, forward PE 54.7 times. So analysts are expecting basically sales growth of around 20% for the next 2 fiscal years, and EPS growth of also around 20% for the next 2 fiscal years. Now, this is the minimum of what we should be expecting, right? We were promised more, but this is the minimum that I would be expecting for Palantir, especially if you think you should be trading at a higher multiple, especially if you are the leader in your field, in AI, stuff like that. I think you should be growing much faster, but that's just me. Up next, we have Morgan Stanley. Some info here with regards to China. So, why is he always talking? So, Morgan Stanley cuts earnings estimates across China's auto chain. Morgan Stanley cuts its price targets on NIO and XPeng while raising its price target on Li Auto and maintaining its overweight rating on them. Why is that? Well, so the analyst team cut their earnings estimate for the Chinese auto chain by an average of 16.4% and 11.8% for 2024 and 2025. Our updated forecasts suggest average earnings growth of 8.8% for OEMs, excluding the EV trio, for which we see 78% revenue growth in 2024. Not too shabby. So they talk here about NIO, XPeng, and Li Auto. These are the trio. The team's average 2024 earnings forecast for OEMs are 7.8% below market expectations, 5.7% for auto parts companies, and 26% for auto dealers. Their forecast for China's total passenger car sales in 2024 was maintained at 25.5 million units, representing a 2% year-over-year decrease. Meanwhile, the team raised their forecast for China's 2024 wholesale new energy vehicle. The number sits at 10.7 million units, up from 10.2 million units, representing a 21% year-over-year increase and a penetration rate of 42%. Pretty remarkable how fast things are going there. This, I think we've seen this. No, this is something new. So China's December wholesale sales of passenger new electric vehicle, new energy vehicle, are estimated at 1.13 million units, up 50% year over year and up 18% from November. Preliminary estimates show that for the full year 2023, China's wholesale sales of passenger new energy vehicles will be 8.88 million, up 38% year over year. So still not that bad of growth rates in China. Not that bad at all. So the team attributes the 2023 sales performance to several factors. One, government support subsidies to sustain consumption amid decelerating economic growth, and rich product lineups with more aggressive new energy vehicles product rollouts, pricing competition amongst OEM, and partly passed on the upstream supply chain to take market share. For solid export progress with leading OEMs accelerating overseas expansion. We've seen that for sure in 2023. Can they maintain that? Remains to be seen. So they say here the team cuts its price target on a number of companies in the auto chain, lowering Xpeng to $23.1 from $25.4, and NIO to $13 from $18.7, but maintains an overweight rating on both companies. Meanwhile, the auto price target was raised by $10 from 53 to 63 and maintained an overweight rating, one of the very few companies whose price target was raised by the team. Okay, interesting. Any China car maker stocks that you're holding for people that are watching? Currently, by the way, the markets, the futures are flat green. So not much has changed with all the news that we're getting. I think that's good. Please, that's neutral, which I'll take as good right now. Yeah, this is a fun one. Let's have a listen to this guy.
How did this happen?
Well, it's been a long process.
How did this happen?
Oh, again with the lag.
From policy to get it off the ground. I think now with the consumer market embracing the technology, it's just nothing but positive news for companies like BYD, who have vertically integrated supply chains and pricing power. They have 6 of the top 10 selling EVs in China. That's just an incredible performance. And now they're going global.
Tell us about the global efforts, right? Because a lot of the success that you've talked about, these achievements are really at their home turf. They've tried to replicate that success in other markets. Can they do so? Well,
they've sold 3 million cars in China last year, in 2023. They sold about 250,000 outside of China. So the BYD success is largely a China story. And frankly speaking, it's because they did not prioritize exports, unlike other Chinese firms who went global earlier. BYD had all the demand they needed right there in their own backyard. So they focused on the domestic market, and I think they have tremendous upside with their pricing advantage as they go global.
Yeah, Bill, what do you think? David here. What do you think of the product as they offer that to the world?
Well, they have a model called the BYD Seagull, which is priced at.
By the way, I know a lot of people will probably watch this guy's interview and say, "Oh, he's a Tesla bear," blah blah. If you look right here, what is this? Right, left. I mean, his right side. That's a Cybertruck model, a toy. So I don't think he's like a Tesla bear. He's speaking facts, by the way. Speaking facts, only talking about numbers right now. But it's important to note that BYD is selling cars that are much, much cheaper than Tesla. They're also selling plug-in hybrids. So yes, overall in 2023, they sold 3 million, but only, I believe, just under 1.6 million pure EVs. Tesla beat that, but Tesla is a global player as well. But also Tesla does not offer a cheap option right now. But I do find it interesting and maybe, funny, but not from a from a fun side of things. The fact that people are happy that an American company, a Western company, is, let's say, losing against a Chinese company. I mean, the world has completely lost its moral compass. I mean, I'm not saying BYD is evil or something, but when you're seeing the constant hate of Americanism, American company, European companies, and then you look at companies like TikTok, which is definitely stealing our data, but they're great, they're good. Let's go on TikTok. Let's allow them to go maybe even public on our markets. Why not? Completely flipped off.
At about 78,000 RMB, which is a little bit less at current exchange rate than 11,000 US dollars. It's well-equipped car. It's got front and side airbags, 10-inch screen in the front of the car. It's an amazing value proposition. They have, the Tesla's been successful with the Model 3 and Model Y, but those cars have gotten older, and they refreshed the Model 3, and they just have a very limited product range. BYD has a very broad product range and a pricing advantage. So I think they're doing quite well, and so far they haven't really shown a lot of showroom cannibalization as they introduce new models. That shows that there's definitely a demand and supply advantage for them.
Bill, what does it mean ultimately when it comes to perhaps investment here as well? I mean, you look at BYD, but they're just one of, tens of BEV and EV makers there. There's got to be consolidation at some stage. And will BYD be growing inorganically? And who should we be looking at as a potential, takeover target?
Well, I don't see that they need to acquire. If there's a gap there at all, it would be in the software side. It would be on the development of the operating system and the platform, which they've now invested a large quantity of money to deploy a a team to build their software capabilities. That's the only gap I see in the BYD system. They're pretty much operating without having to raise funds. They're profitable on a standalone basis. They have upside in terms of markets that they can grow into beyond China. 35% market share for new energy vehicles. That's more than a third of the China market. So I really think that they're firing on all cylinders right now as a company.
So what about, the second part of the question was, do you see a huge amount of consolidation in the industry in China with the amount of EV makers there are?
Oh, absolutely. Well, right now, what we're seeing in China is it's a secular shift and a generational shift. Basically, the market is not growing in the aggregate. The only growth in the total production and consumption is in exports. The China market as a whole is not growing. So when the EV share increases, it's basically taking it away from the gasoline-powered segment, the ICE segment, which is shrinking rapidly in China. I do see a need for consolidation for sure. because the top 5 companies get 2/3 of the market. The top 10 companies in the EV segment, which is the only growth segment, the top 10 get 80% of the market. So there's definitely more companies than there need to be in China right now in the EV segment.
Bill, can you tell us a bit more? I mean, as we kind of talk about the overseas expansion, right? You have the EU; they could be slapping tariffs on Chinese imports sometime soon. You have the U.S. also cutting the amount of models that they can have to get that tax credit by half. I mean, how does BYD navigate those sort of geopolitics?
Well, right now, I think the issue is tariff. And even if you slap a 27 or even higher percentage tariff, you're still talking about a pricing advantage relative to where the multinational companies are positioned. So I don't think a tariff is going to help. First of all, will it help slow down the rate at which Chinese companies may access the market? For sure. However, I don't think that is a solution that helps domestic consumption in the United States or in Europe of electric vehicles. If the intent is to grow the EV market, then you need to produce affordably priced EVs, and just erecting a trade barrier to prevent not only Chinese OEMs from selling cars in the United States, but preventing the Chinese supply chain, which is the highly scaled supply chain for electric vehicle components. If you add tariff to that, all you're really doing is adding costs to the American consumer for accessing a highly scaled supply chain like exists in China.
Bill, somewhat along the same lines is also, I mean, chips go into everything these days. Is where I'm trying to get to, and constraints to limit China's access to the most advanced semiconductor technology. Do you see that in any way limiting the growth of these EV makers? Of course.
Sure. I don't think it affects EV as much as certain other technologies, such as autonomous driving. But I think again, the unintended consequence of erecting barriers like this is it actually accelerates the movement of Chinese companies to become self-sufficient, or to expand their supply chains to make them less Chinese. In other words, investing in overseas markets to be able to access benefits from being able to produce outside of China. China in particular is investing heavily in Mexico, obviously with the intent of not only selling in Mexico, which is a much smaller market than the United States, but Mexico has a USMCA agreement with the United States. So it's an opportunity for China to kind of go global faster. So yes, chip technology, again, the blowback on that is going to be China can reciprocate by making rare earth elements or battery technology.
I want to pause right here, and I mean, we're going to switch with the big announcements soon. But the fact that BYD and all these Chinese companies are showing that they can grow quite fast shows you that there is plenty of demand for EVs, especially affordable EVs. Now, what have we been seeing in the last couple of months, right, from legacy media, from legacy automakers, is suddenly the headlines of maybe there isn't a demand for EV. Well, if that was the case, players like BYD, Tesla, Li Auto, right, XPeng, NIO more recently, their demand number, their sale numbers would have been much lower, but that's not the case. So the problem right now is that there is a lot of demand, but the affordability of the offer is not there yet. Again, BYD offers plenty of models. That's great for them. I mean, people say, oh, Tesla only having 4 models, 5 models is great for the business. I always think that you have to give people a little bit more choice. Of course, the compact car will change the whole game, but I think we're still a year or two away from an actual launch of the compact car, but that will definitely change the whole game. An affordable, great EV from a Western company, because remember, and this is very important, so I'll zoom myself in a bit. Very important to note that if we're going into an autonomous future, the question is very simple here. Would you like Chinese tech in your company, Or would you like Western American tech or German tech in your company, in your car? Who do you want to drive your car, right? The CCP or an American company? To me, the answer is here pretty clear and pretty simple. I will never buy a car that runs on CCP autonomous software. Never. You never know what might happen. Now, of course, conspiracy theories, you never know. You never know, right? You have TikTok on your phone, they probably have access to a lot of your data. So, yeah, not a big fan of that. Now, moving on to the big announcement right now is this. Apparently, Apple has just announced the date where you will be able to sell an organ and get a Vision Pro. So the Vision Pro will launch on February 2nd, but only in the United States. Pre-orders begin January 19. How much would it cost? It will cost you just under, I believe, we can see the pricing probably all the way down. It's $3,500 basically. $3,500. You have gaming experiences, entertainment. They say here you will have access to more than 150 3D titles with incredible depth wherever they are. Gaming room, 250 titles on Apple Arcade, hit games like NBA 2K24, Sonic Dream, etc., etc. So, yeah, FaceTime. My question is, do you need an iPhone to operate this or not? I mean, probably not, right? Hopefully not, because then, well, you're just forcing people to spend $5,000 to actually operate this whole thing. Yeah, so here, $3,499 in the US with 256 gigabytes of storage. All US stores. Then you have optical inserts readers will be available for $99 and optical prescription ones $150. So for those of you that want to try it out, start saving for the Apple Vision Pro. Does it work independent or not? They talk here about Siri. With Siri, users can quickly open or close and play media and more. Yeah, it will be interesting. There's probably enough demand for early production, right? All these fanatics, Apple fanatics, that will probably buy it no matter what. Remains to be seen how much they will be selling it for. I think this will definitely also increase the demand for the Quest 3, which only costs, what, $500 or so? So, yeah, we'll see. We'll see exciting times in this space, that's for sure. Exciting times in this space. Markets have opened, and we are basically flat. 0.18 in the green for S&P. Dow Jones is down, but that's basically because of Boeing. Nasdaq 0.4 in the green as well. Crude oil continues to drop, down 4%. Boeing, let's see how much. Yeah, down 8.7%. So with that, quick live stream, fun as always. I hope you all enjoyed it. Again, in the future, let me know pre-market, after market, maybe prepare some questions as well. If you enjoy this type of videos, live stream, let me know by hitting that thumbs up button. Subscribe if you're new here, and I'll see you all in the next one. Bye-bye. Have a good day.